Now, just before we move on to the equity markets in Nigeria, it would be great to analyze the broader frontier markets across the African continent. So far, 2013 has been a good year for the major frontier markets on the African continent, and to review these markets and to share some perspective on how to invest in them. For more on this, we're joined by Ayo Salami. He's Chief Investment Officer at Duet Victor Africa Index, and of course, he's reaching us from London. Ayo, thank you so much for joining us. And like I mentioned, it has been a pretty good year for most of the markets in the frontier market in Africa. For instance, we have the Nairobi market up about 36%. Nigeria, of course, is up just under 30%. Ghana leading others up about 55%. So your thoughts on how well the markets have done this year, and of course, where do you see them going from here?
Well, as you said in your introduction, a lot of the African frontier markets have done very, very well so far this year. Ghana is leading up almost 50%. Nigeria, Kenya up in the high 30s. We think a lot of this has been, it's a combination of the strong macroeconomic story in the region, increasing foreign flows. That's one of the strong themes that we've seen since the beginning of this year, has been the increase in the amount of foreign participation in the African markets. So we're now, the performance of these markets and these economies is getting a broader hearing. We had very good coverage for Africa in The Economist earlier this year. We had the Financial Times dedicate several special issues to it, and that has created an interest, and that interest has now begun to result in flows, and those flows we think are also providing an underpin. Of course, there's the domestic story. The performance of the corporate sector itself, it's not all hot here. It's not a bubble. The companies themselves are doing very, very well. 2012 results from most of the corporate sector was quite encouraging. Average earnings per share growth in sub-Saharan Africa last year was in the low 20s, and we think we'll probably see the same again this year.
All right, so you made a good point about foreign investors really driving the moves across this market. But is that a good or a bad thing? How risky are these flows in your view? Because clearly, if we see them pull out very quickly, it could disrupt the local markets.
Well, that is an interesting new dynamic that's happening on the African markets these days. Historically, if you were to go back, say, before 2008, the last marginal trader is the one who sets the price. And historically, the last marginal trader in sub-Saharan Africa was a domestic investor. Now, in certain segments of the market, not across the whole market, but in certain segments of the market, you are now beginning to find that the last marginal trader is actually a foreign investor, especially those stocks which we will call the branded multinational stocks, African subsidiaries of foreign multinationals which are known to international investors. Predominantly in most of those stocks, East African breweries, Nestle Nigeria, Guinness, Lafarge, WAPCO, you are finding that the last marginal trader is now increasingly a foreign investor. I would say, for the time being, that it's not a matter of concern, because globally we seem, the global background seems to suggest that investors are in a risk-on mode, but certainly it would create challenges if all these guys were to try to exit at the same time. But I don't, in the absence of what I would call a black swan event, whereby we had some kind of event that that caused ructions in the global financial markets, I don't think we would see. I think most of this money is coming in for, they believe in the story. It's to gain exposure to the growth of the continent, and I don't think they are it's not yet short-term fast money.
Okay, let's talk a bit about how pricey these stocks are, particularly in markets like Nigeria, and maybe I imagine that it's probably a similar theme across the continent, making a play for the consumer. We see consumer-focused stocks like Nestle Nigeria, you mentioned earlier, Guinness, Nigerian breweries, looking a bit pricey right now. Your thoughts about the valuations of consumer-focused companies across the continent, and where do you see value?
Undoubtedly, those type of stocks, again, what we will call the branded African consumer stocks, they're now looking fairly straight on valuation. Most of them are trading on price earnings ratios above 25. And I think part of that is the dynamics of what we'd already explained, that you have a new wave of investors who want to gain exposure. They are at the moment following a cautious path. So they are looking at those stocks which they know something about from the developed markets, and they are following them through into Africa. So in that segment of what I would call the consumer-facing African subsidiaries of multinationals, it is difficult to find value in those stocks. The segments of the market where we find value are now what we call the second tier, the second line stocks. African-focused companies which are run by Africans, they don't have any association with foreign multinationals. Those you still tend to find that their PEs are somewhere between the range of 10 to 15. So I'm talking about stocks like Dangote Sugar Dangote Sugar in Nigeria would be a classic example of a company. It faces exactly the same dynamics in terms of the exposure to the consumer sector, but it hasn't found that much favor in terms of buying pressure from foreign multinationals. When you go to East Africa, we look at companies like Athi River Mining. When you go down to the Southern African region, we're looking at companies like Letshego and Choppies, where we still see these sort of companies still have their valuations are still sort of relatively reasonable. In terms of our overall view of the market, I would probably say consumers are looking, the typical consumer-facing stocks are looking fairly stretched. Among the banking stocks, there's still a lot of value to be found there. Even among the Nigerian banks, after the recent hard run, you still find, there are some Nigerian banks like Sky Bank, like FCMB that are trading below book. So if you look hard enough, you can find value. You can still find value in the market.
All right, you just mentioned some of the tier 2 names in the banking space in Nigeria. Of course, there is a view that we should see some consolidation, particularly with the AMCON-owned banks coming into play. So your thoughts about how that increases either the opportunity or the risk of buying into the tier 2 names in Nigeria?
Undoubtedly, if you look across the Nigerian banking sector, I think Nigeria has about 24 banks. It's too many banks for the size of the Nigerian economy. Now, the rational expectation is that there should be consolidation. The issue is whether consolidation in the banking sector will be regulatory induced or whether it will come from market forces. Nigeria does not have a history of the market for corporate control in Nigeria has not got a history of working to force consolidation. It's more likely to be something to come from the regulators. In that space, probably the first lot will be the 3 banks which are under AMCON's curatorship at the moment. Probably, they might offer opportunities. When these banks come up for sale, it might be a combination of both foreign buyers and Nigeria and domestic banks that will take them. Then you probably will have to see a second wave of consolidation in the industry. But I think that will probably be something that will come more from regulatory pressure rather than from market movement. It is difficult if it's not coming from market forces, it is difficult to position a portfolio to try to take advantage of it, either for or against. So I don't know that there's much one can do until we actually see the regulators beginning to take active steps to try to encourage consolidation in the industry. Otherwise, when you invest in Nigerian banks, it's a simple case of look at their ROEs relative to their price to book ratio.